Hello and welcome to the first of our Working Capital Management series of web chats. We are joined by Brian Shanahan, CEO and founder of Informita and termscheck.com, and we're going to be discussing a perennial problem in working capital management, getting paid on time. And we're going to be examining three very important aspects of this. You talk about this, Brian, in terms of the first problem is customers are not all the same. What do you mean here? What's going on here?
Well, very often everyone wants to treat everyone with the same paintbrush. And the problem with this is that firstly, on this scale, you'll see that you've got big customers and you've got small customers. So you probably, from a value perspective, need to focus on the high value guys before the low value guys. But also, when you look at the actual data that people have in their own ledgers, you can see that there's people who are good payers and people who are poor payers. And the reality is you shouldn't treat them all the same. And if I just give one example of that, if I have a team of collectors and I have 5,000 customers, even hundreds of collectors wouldn't be able to reach that number of customers. So I need to focus very quickly on who are those people who I make those calls to. And that's why in this diagram, you've got the red shaded boxes, because that's basically telling you the area where you should be focusing on calling customers, i.e. the higher value and the not so good payers. Yeah.
But isn't it also reflected, the problems are reflected in the type of products they're buying, because doesn't behavior change by type of product?
It can to some extent. For instance, services. The classic is, if they need to be commissioned, like computer systems or something like that. So it's not just a necessary, you deliver the service, but it also has to be accepted as being adequate and good and all that. But if we talk about goods generally, that's a lot simpler. But the problem is, it's not necessarily the service or goods that you're delivering, although that can have a small impact. It's the behavior of the customer behind that. And you very often find that the customer who pays you late pays everyone else late too.
Oh, right. So it's to identify those who've got good habits and those who've got bad habits.
That's absolutely right. And when you look at this kind of scale, what's also interesting in looking at a value opportunity is that everyone has this range of customers. So everyone's got good guys who pay you early even or on time. You have people who pay just slightly over time, which is your number 2 class here, or 3 classes where you have people who are quite frankly, just really bad payers. But very often you find the people in the third column, their own processes are just amazingly disorganized. And that's why this happens.
Okay, so if we then move on to the second issue, dispute management. Why is dispute management a problem? Because it seems to me it's all the same, isn't it?
Well, for instance, let's say I call my customer. It'd be very simple if they just say, "Oh, terribly sorry, I forgot about that. I'll pay you on Friday." But very often, what happens on top of that is the reason they haven't paid you is because there's been some kind of problem. So in that respect, one, it's important to call again. But two, what this tries to tell you about is the structure then you should deal with that issue. So let's say it could be a simple thing like, I forgot to send the invoice. VAT was calculated incorrectly. There's lots of very small admin type issues that cause problems. I mean, there's big contractual ones as well, which thankfully are rarer, but they do happen. But the point of this is, firstly, you need to identify the fact that there is a problem, so hence the reason for the call. Secondly, categorize what the problem is. So is it some kind of basic admin type thing versus maybe it's some kind of quality control issue or something like that. The assignment often is because very often the person in finance is not the person who can actually solve the problem. Not always the case, but often the case. So we need to make sure that we've assigned the right person in the organization who's going to resolve this problem. Fourth one, we need to track up those folks to make sure that they do that within the timescales we set them. And obviously you need to make sure, lastly, that you actually resolve the problem. Because if you don't resolve the problem, ultimately the customer's not going to pay you.
This sounds quite a complex process. Do you recommend particular platforms to do this?
I think you find now most ERP systems do this, at least in a basic way, but there's lots of middleware platforms, things like Get Paid and so on, which probably do this a bit more effectively.
And what's the sort of return for the investment here?
Well, it depends on who the investor is. I mean, for example, if your major shareholder is a PE company, then every single dollar of cash you get out of this is an extra dollar on valuation. So it's almost one for one return. If you go back into the real world, then it's really based on what the cost of money is for that organization. Now, interestingly, if we look at interest rates, which is a big subject these days, are still at virtually zero in most countries. But actually, the return that companies get is a lot higher than that. So even if we say conservatively, let's say 5%, then that's a much better return versus the vast majority of investments that can be made in the market.
Another way of looking at a return on investment in dispute management is in terms of reduction of days payables outstanding. What sort of numbers have you seen there?
Well, it does obviously depend on company by company, but there's two basic problems in dispute management. One is, did I create a problem in the first place? So obviously that's something you can eradicate over time. And the second is that once I know about what the problem is, how long does it take me to resolve? Now, you find with companies that don't have this kind of process at all, and just try and do it in some ad hoc fashion, that it can take something in the region of 40 days very often to actually resolve what we'd recognize as a dispute. And when you get into a more structured environment, you can actually cut that down to 10, 15 days or even lower in many cases. So it can have a dramatic reduction. And that in terms of DSO profile, if you assume an average payment term of around about 30 days, this can easily account for 3 or 4 days of that DSO.
I should have said DSO rather than DPO. Sorry about that. So this is a significant return on the investment, but does it upset the recipients? I mean, what's the reaction when you go into this process?
Well, what it isn't, is people calling, you're calling your customer and saying, I want my money now, because that would be quite rude. So very much you're taking a customer service approach. So when you make the call, you're asking simple questions like, did you get the invoice? Was the invoice okay? Has it been cleared? Stuff like that. So you're trying to understand what the customer's internal process is. And you very often find that it may be the customer has done something wrong. It may equally you've done something wrong. But because you're asking the right questions in the right way, it actually proves to be a positive service for the customer, rather than being viewed as something negative.
And you keep talking about calling the customer. Is it always calling? I mean, is there a way of using the emails and other things, or is it purely telephone calls that work?
Well, the best method is telephone calls, but if on the 9-box chart on the previous page, I'll give you an example. One client I have, and they've got 5,000 customers. They have the capacity to call somewhere between 200 and 300 of those customers every month. And by capacity, I mean the number of collectors they have. So the remainder, you can't ignore them, but you don't have the capacity to call them. So this is where we use what we call dunning processes. Now, dunning processes years ago were physical letters. So if you're 7 days overdue, you get the reminder. Very similar to like your utility bill and the way that kind of works. If you don't pay it, you get a reminder, then you get a final notice. Increasingly now, those communications are done by email rather than physical paper, because it's cheaper and it's faster.
Another problem that I'm reminded of is the difficulty in identifying who in the customer is the person to talk to. How do you resolve that?
Well, I think that's a problem for everybody, unfortunately. But the best way is if you have a professional collector, their first port of call will be the accounts payable department of the customer. But from there, that accounts payable person will know usually exactly who the invoices come from, who needs to authorize what, et cetera, et cetera. And it's the job of the collector to find out those things so that on the first occasion, it may not be known who authorizes invoice X, but then on every occasion after that information then is known. So, for example, if the accounts payable person is not able to resolve a particular issue, then potentially the collector can get directly onto that person who's responsible for whatever part of the process on the customer side.
There's a big reliance here on collectors. What's the difference between a good collector and somebody who's not so effective?
It's all about how passive you are. So, and what I mean by that is, like, passive, the numbers just come in, they are what they are, they're good, they're bad, whatever. The passive person will not know about customers, will not know about their internal processes, will not have any idea of who the people are who can resolve these things, because quite frankly, they don't call very many people. And the people who call, and this is much better than email, by the way, because email can be potentially quite passive as well. But the person who calls, you're not just asking information. Well, obviously, your ultimate point is to have information about the invoice that's outstanding, but also you're also generating a relationship with that person in AP, who then, quite frankly, might volunteer all sorts of information which would be useful to you, which you otherwise never would have heard of.
Interesting, really interesting. Now, the final piece of the jigsaw, as it were, in getting paid on time is the payment method you accept. Now, you're saying accept only electronic payment only.
Yes.
Surely that doesn't work in every country.
I'm hard pressed to think of a country it doesn't work in. I think the bigger issue is not whether there is a mechanism for electronic payment to work in whatever country we care to choose. It's whether there are some people left who prefer to pay by check for various different reasons. I mean, the classic one, say in the United States, is people will talk to you about float time. And this idea that if I, send a check to a lockbox in Guam, by second-class post and so on, that by delaying the physical check getting to you, then it obviously delays the clearance of that check and the cash ending up in your bank. Now, that might sound intuitive, but actually, if you're a treasurer, that's a terrible process, because then a treasurer then can't predict the exact date that the check needs to clear. Therefore, may not have the right amount of funds or too much funds in accounts that, quite frankly, don't bear any interest or any profit. So it can actually be quite a countermeasure in terms of managing your cash flow. But if you look at other countries, a great example is Germany. The vast, vast, vast majority, 99.999% of payments happen electronically. The big exceptions are very often the major German retailers who insist on paying by check because they've been infected by this float time idea. And actually all it does is just annoy their customers. And anybody who deals with these people, this is an issue. Does that mean that you then can't convert these people to say pay electronically? Yes, you can, but the key thing is you've got to ask the question. And if you see, for instance, in the UK, this has been a big issue over the last 20 years. But if you look at the percentage of check payments versus total payments, it's been declining every year for the last 20 years.
So what's the arguments you present to get people away from checks?
Well, the first thing is it's safer. A classic one for me, I was working with a client and we were having this discussion. It turned out that a check for $5 million was stolen, and then someone tried to present that check, obviously trying to forge their name on the particular check. Now, they didn't get away with it, but if they had of, that would have been a very expensive problem. The second thing is the certainty of it. What I mean by that from the customer perspective is, if I'm a treasurer and I know that the money has to leave on an exact date, then I can plan for that. And in terms of how I shift my funds around from a day-to-day cash management point of view. And that means that I'm actually making more for that cash on a day-to-day basis, rather than I'm not quite sure, will that check hit the bank this week, next week, on a particular day, I'm not sure.
The final thing that's happening in electronic payments is that we're getting more alternatives to, I'm assuming you're talking about automated clearinghouses or gyros. We're getting alternatives. Are you seeing any use of the alternative electronic payment systems?
I don't think it's a significant thing at the moment.
Well, thank you, Brian. That's most interesting and some seriously important tips for corporate treasury departments around the world. Thanks.
Thank you very much, Jack.